Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks pulling back from records here as the Federal Reserve kicks off its September policy meeting. Investors are digesting new retail sales data. We're digging into those stories. And right now, there's just an hour to go to the closing bell. Taking a look at the major averages, you can see the Dow's down about 80 points. S&P 500, the NASDAQ, both roughly flat here. Let's welcome in Fed correspondent Jennifer Schonberger and data and markets editor Jared Blickery joining us to break down the headline. Jared, let's start with you, my friend, on the trading action so far today.
Thank you, Josh. Well, we got a mixed market right now. We did start the day on a record note for the S&P 500 and the NASDAQ Composite and the NASDAQ 100. But here's the Dow. This, as you can see, started off in positive territory, a little bit in the green there towards the open, drifted down into the red, and just has been kind of hovering sideways ever since, only down about 82 points. Not a big deal there in the grand scheme of things. NASDAQ slightly positive, S&P 500 slightly negative, and so not a whole lot of action in the major indices. And let's go to the Russell 2000 as well, which has seen a little bit more negativity than the others. Also started out the day just a little bit in the green, but the small cap index off about 0.25% right now. And we'll get a check on the 10-year T-note yield. That is down 1 basis point to 4.03%, edging closer to that 4.0%, big psychological level there. 30-year is down to 4.64%. That's down 1 basis point. And I also like to get a read on the 13-week T-bill. Here's a 1-month chart, and you can see this closely tracks what the Fed is going to be doing with short-term rates. It is now down to 3.89%, down another basis point. So traders pricing in those rate cuts as we speak. And here's the sector action. We got energy in the pole position up 1.75%, followed by consumer discretionary. That is a Tesla story. Tesla's been on a nice multi-day run there. Then after that, you got staples and healthcare. Those are the only sectors that are outperforming and in the green. Utilities leading to the downside, down about 1.6%, followed by real estate. And so kind of a flip from yesterday when we had those mega caps really solidly leading everything. We're still seeing some green here, so don't discount that. Tesla's up 2%, Amazon, Meta, Apple up 1%, Alphabet just barely positive. That thing has been on a streak over the last month, approaching 25%, I believe. But Nvidia down 1.5%, Microsoft just about down almost 1% there. And let's get a check on China. Haven't done this in a few days. Just want to highlight, seeing a lot of green here. Alibaba up 2%, JD up 3%, Trip.com almost 4%, and Baidu up 8% along with NEO there. So China kind of uncorrelated to the rest of the markets we track here. Interesting to see that as one of the leaders today. Speaking of the leaders, here's my ETF board. And in the top spot there, we got cannabis followed by Korean stocks. That ETF, EWI, kind of a proxy for chips. Then we got ARK Innovation Fund. Biggest holding is Tesla, so we already kind of covered that. KWeb is China, PSCE is small oil, and then we got solar and Bitcoin. So let's end on crypto here and check out Bitcoin up about 1%, and I'll give you the read on that number, 116,542, Josh.
All right, now to Capitol Hill, where just hours ago, the Senate confirmed Stephen Miran as a Federal Reserve governor just in time for the start of its FOMC meeting ahead of Wednesday's rate cut decision. Jennifer, there's a lot of anticipation. The drama is building. Jen, set the scene for us.
The drama is building, Josh. Indeed, the Senate confirming Stephen Miran to the Federal Reserve Board last night, just in time for the Federal Reserve's policy meeting, which kicked off earlier today. Now, we know that Miran is a dove, and we expect the central bank to cut its benchmark policy rate by 25 basis points on Wednesday. The question is whether Miran will go along with that cut or whether he will dissent because he would prefer to cut by a larger amount. He is just one vote of the 12 voting members of the 19-member FOMC committee who cast a vote. But Miran said that he would not resign from his White House post as the President's Council of Economic Advisors chairman because he says he is only serving a stint of 4.5 months at the Fed. Therefore, he will return to the White House after serving at the central bank, something that has raised a flag of concern for Democrats over central bank independence. In fact, ahead of Miran's confirmation, Democrats sent a letter to Miran asking him to resign if he was confirmed by the Senate and asking him whether he would share any conversations he would have as a Federal Reserve governor with President Trump, with congressional members, with lawmakers, both of which he said he would not do. Meanwhile, the president is, Miran's confirmation comes as President Trump is seeking to fill the central bank with people who are in favor of lower interest rates. When President Trump was asked whether he favors an independent central bank, he told reporters this upon leaving the White House this morning to go to the UK.
It should be, but I think they should listen to smart people like me. I think I have a better instinct than him. If you look, all the economists got it wrong. I got it right along with one other people out of 100. So they should listen to people that are smart. Nothing wrong with that. But they have to make their own choice. But they should listen.
The president tried to remove Federal Reserve Governor Lisa Cook from the Fed board ahead of today's policy meeting, but an appeals court has rejected that. The administration expected to appeal that to the Supreme Court. I will be talking with the ranking member of the Senate Banking Committee, Senator Elizabeth Warren, about central bank independence next hour. Josh?
All right, we look forward to that interview for sure. Jen, Jared, thank you both. Appreciate it. Well, Wall Street awaiting possibly the most important Fed decision of the year on Wednesday, with retail sales coming in strong on Tuesday, though investors may be wondering if the market even needs a cut to keep moving higher. For more, we're bringing in now John Hilsenrath, Senior Advisor at StoneX, and Jeff Klingelhofer, Managing Director and Portfolio Manager at Aristotle Pacific. Guys, welcome to you both. Jeff, I'll start with you. You know, the Fed decision on deck, Jeff. We are very certain we're going to get a cut tomorrow, Jeff. Let's start with that question, though. In your opinion, you look at the data, Jeff, are you convinced we need a cut here?
You know, the way I would talk about it is the Fed's classic dual mandate is in tension today, and there's no question that the jobs market is softening. But on the flip side, what we saw out of last week's CPI print is that inflation is also broadening, and so today we're perhaps even more in tension. When I look out at the world, when I look at financial markets, to me, I think 25 basis points in a day is about right, but I think the markets are far too ahead of themselves with a very strong assumption that this isn't just the first of one Fed cut or the first of two, it's the start of a durable rate cutting cycle. And that's really where I become apprehensive, because the data is just not there to support that today, and I think the Fed will talk about being data dependent into the future.
Let me ask you, when you saw that August retail sales this morning, though, beat expectations, the control group, which feeds into GDP, that was above consensus. Do you think that gives the hawks, Jeff, maybe a little bit more ammo?
You know, I think it exactly does. And I think going back to one of the earlier comments from President Trump is listening to smart people. We should also be listening to the actual underlying data. And the data today tells us that the consumer, albeit in a weakening spot, is still very, very strong. The way I like to think about it today is it's less about actual incomes and therefore jobs. And today, what I'm watching more closely, and Aristotle Pacific is watching, is a lot more focused on financial conditions, because that re-leveraging cycle is playing out and it's supportive, and that's coming through in the data today.
John, I want to bring you in here as well. What are you looking for tomorrow, John? What do you expect to see and hear? And what do you think the pace of cuts looks like?
Well, I mean, I agree with a lot of what Jeff just said about where the economy is and what's justified. Let's not forget the inflation rate is around 3%, which is above the Fed's 2% objective. I think tomorrow, when the Fed revises its forecast for the economy, we're going to see them revising up their inflation forecast for 2026. So it's not screaming rate cuts. But of course, there's the political backdrop to all of this, which makes it a bit of a challenge for Jay Powell to navigate and kind of storytell. I think what happens tomorrow is they cut rates by a 0.25 percentage point. They write down in their so-called dot plot, which is their projection of where the Fed funds rate will be at the end of the year, a total of 2 rate cuts, so one more after tomorrow's. But then in the press conference, Powell leaves the door open to possibly 3. I think what he wants to come out with tomorrow is options. He wants optionality. If the job market continues to show signs of weakness, if we get another really bad payroll report, he wants to be able to move again in October if he has to. So I agree the market has gotten a little ahead of itself, but he doesn't want to completely pull it back. He just wants to get some cards in his hands. One other thing I'll say is everything we're talking about changes next year as there's a new chairman appointed to the Fed and potentially more Trump appointed governors. the kind of dialogue that we have about what's justified and when becomes, frankly, an increasingly political dialogue of, where are the political winds moving this institution?
John, I'm curious, let's say it plays out tomorrow exactly as you think. I'm interested, how do you think the stock market would respond and react to that?
Oh boy, I always have such a hard time saying. So I think that the Fed now is more dovish than it was in June when it, last put out its economic forecast. The job market has deteriorated, but I think it's more hawkish than the markets have been because, as Jeff said, the markets are pricing in with pretty high probability that the Fed is going to cut rates 3 times this year. So I think we'll see some volatility net. Maybe there's some disappointment that Powell and the people behind him didn't dial in 3 rate cuts for the year. So I'd say there's some possibility for a little bit of a sell-off. But again, he wants to have his options open, so he's going to leave something for everybody to read in the way they prefer out of tomorrow's meeting.
Jeff, we mentioned how Stephen Miran getting the green light. He's headed to the Fed. There have been concerns raised in some quarters, Jeff, about Fed independence. How much, when you're talking to clients, Jeff, how much are they bringing that up as a worry, as an issue?
They're bringing it up quite often about a worry and an issue, but I would say I'm a little bit more sanguine, actually, when we talk about Fed independence. Look, I tend to think about the Federal Reserve and go back to their actual mandate, why they were created, and that is to break the potential pass-through from kind of the reckless fiscal authorities, if you will, and prevent the pass-through of inflation. And I think no matter who ends up in that seat takes that mission, takes that mandate very seriously. Today, inflation is running about 3%. It's slightly higher than the Fed's overall price stability target, but it's not tremendously missing. And I think what markets should be concerned about is what happens if and when it does continue to rise. But ultimately, if that happens, I think the Fed goes back to job number 1, and that's a focus on maintaining independence and focusing on keeping inflation expectations well anchored, and they will do exactly that.
Jeff,
well,
John,
if
John,
I may, I'll take the other side
last
of that
word
one.
there.
I'll take the other side of that one. I understand that that these are people with their own free will, and they're putting their hands on the Bible and promising to follow the mission that Jeff just described. Having said that, there are 7 people on the board of governors. If 4 people loyal to the president and his way of seeing the world take a majority on that board, then not only do they drive the decisions of the board, but they also can reconstitute all the regional Fed banks. So I see scenarios where a Trump majority takes hold. Became very close this week if Lisa Cook got fired. I also see scenarios where, potentially the old guard means some element of control. There are wild cards. We don't know where Fed Governor Chris Waller is going to come out on all this. I think that independence and the risk of a policy error is higher today than it was a year ago. I'm not convinced that a bad error is going to happen, but there is a real chance that this institution becomes politicized and starts making mistakes.
John, Jeff, we'll leave it there. Thank you both so much. Appreciate it. And be sure to tune in to our live coverage of the Federal Reserve decision and Fed Chair Jerome Powell's news conference that will all start at 2 p.m. Eastern. We are just getting started here on market domination, but coming up, America's housing market is at a pivotal point. What will the Fed rate decision mean for buyers and sellers? Plus, Wall Street initiates a new kid on the block, Klarna. We're telling you who's a buy, sell, or a hold. And some sweet news for Hershey Foods. The stock is rising. We'll explain why. Those stories, a whole lot more coming up. Builder confidence is steady, remaining unchanged in September, according to NAHB. But as the Fed is expected to soon cut the federal funds rate, the housing market is seeing future sales expectations hit a 6-month high. For more on the state of housing is the CEO of the National Association of Home Builders. That would be Jim Tobin on set. Jim, great to see you as always, sir.
Great to be with you.
So let's get to this number. So builder confidence, Jim, 32 in September. That was unchanged from August. It looks like they came in just slightly below consensus, but walk us through that number, Jim. What do you make of it?
I think we're at the bottom. I think we finally have hit the trough in builder sentiment, whether it's tariffs, whether it's immigration policy, whether it's the economic cycle. I really think we've hit the trough. We've seen that over the last couple of months.
What gives you that confidence, Jim, to say that?
First, I think we've seen tariffs seem to be kind of working their way into the economy, even though we've got some way to go here on some of the larger trade deals, number one. Number two, immigration enforcement has been spotty. And number three, we just saw the middle class tax cut that the president signed into law. That's got to work its way into the economy too. And so I really think that we're starting to see what the Trump economy looks like, and we're starting to absorb that into our future expectations.
Let me ask you, so all eyes on the Fed this week. We're very certain the markets are, Jim, you're going to get a cut tomorrow. Okay, let's say you get the cut. It's 25. Right. What does that actually mean for the 30-year fixed?
I think it means very little, other than we're starting to see some confidence in, again, the future of the economy. And I think that helps set the bond market, the 10-year Treasury, obviously we watch very closely, and that ends up kind of setting mortgage rates. However, what it does mean for builders in the short term is acquisition, development, and construction lending. Those loans that are made to builders from community banks, that is more closely tied to the Fed funds rate. So as those rates come down, borrowing for builders to start projects are going to drop too.
Let me ask you, you have very smart economists on staff. Do they try and model out, okay, we think the 30-year fixed is here in 12 months? And if so, what do they say?
We do. We think it's going to be, we're not going to really crest below 6 until the second half of next year. We've delayed that. We were, pretty much thinking we were going to be past 6% at this point in the cycle, but now we're looking at closer to the end of 26 before we really feel a solid, consistent mortgage rate under 6%.
Can you pin the level where, okay, this is the level that would jumpstart a lot of activity? Is it 6? Is it a 5 handle?
Yeah, I think you get to 6 consistently, and then you can buy down into the 5s, and that's when people start to come back. I'm optimistic. A year ago, if you asked me, 5.5 seemed good. I'll take 6 these days. But I think people are going to move on their own economic situation, chasing a job, increasing the size of their families. That 6 gets a little bit easier to stomach because you can refi within the next couple of years, hopefully.
What about the fact, Jim, folks bring this up, we're all waiting for tomorrow, but the Fed did cut last year and mortgage rates still finished the year higher, right?
Yeah, I think it's that overall piece of the economy. Remember, we were right in the middle of the election season, so you're worried about what the direction of the economy based on who won the White House. We know that now. We also seen that the Treasuries have done kind of an interesting deal over the last, stock markets rose, bonds market has fallen. It's a weird dynamic. So I'm optimistic that everybody will start having a little bit more sense and comfort in what the economy is going to be.
I see reports, and I know you saw this too, Jim, that Trump has considered declaring this housing emergency. It doesn't look like we had a whole lot of details on it. I saw maybe standardized building and zoning codes, maybe trim closing costs, but you saw those headlines and reports. What did you make of that?
Yeah, I think what I make of it is that housing continues to have its moment. Big part of the election last year, both candidates, President Trump has talked about housing. To see that he's going to take some federal action, especially on those regulatory side of things where the federal government really has a better role to play. But trying to cut those costs, whether it's regulatory, land use, codes in particular, adding tens of thousands of dollars to the cost of housing. If we can trim those back, we can build a much more affordable product.
I'm sure you're all a talk in the White House. When they come to you, Jim, and they say, hey, what can we do about the housing market? What do you tell them?
Regulation, regulation, regulation. First, work on the federal regulations that impact land development and building constructions. Do away with some of the things we saw over the last 4 years, which is really trying to socially engineer housing in this country. And then see what they can do to put pressure on local governments to get out of the way, whether it's building more infrastructure, investing in land use decisions that actually build more housing, saying no to the NIMBYs and saying yes to the YIMBYs, the yes in my backyarders, and realizing that the real solution for housing affordability in the country is to build more supply.
What about other Trump policies? I know you hinted at that, but tariffs, deportations, what do you see and what do you hear in terms of the impact of that?
We've definitely seen the uncertainty in the tariff space increase costs. Maybe between 10 and 11% on the cost of a house when we talk to our members. But again, it's been spotty. The tariffs come in, then they go away, then they come in again. But we have seen producers raise their costs on the threat of tariffs. even though those tariffs may never be realized. Deportations, again, we've seen the labor supply tighten, but that has been mitigated by the slowdown in building, so you don't see those pressures on the labor market as you would. Now, if we get going over the next few months or 6 months, I could see labor becoming an issue for us.
Jim, always great to see you, especially on set. Thank you, sir.
Thank you.
All right, now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me now for a look. We're going to talk Klarna, maybe a little Ralph Lauren, throw in some Hershey. Starting with Klarna, Wall Street analysts initiating coverage on the stock following its debut on the New York Stock Exchange last week. So analysts weighing in here. Brooke, what do you do with this one? They're giving advice. Compass Point Research says it's a buy, actually. They talk about its growth outlook, ability to grow market share. Target is 53.
Yeah, so right now, keep in mind, this company just went public, and so we're only hearing from very few analysts on the street initiating coverage this morning. Not only had Compass initiated a buy, but we also did hear from Needham and Morningstar. They initiated what would be a hold, a market perform on the stock.
Yeah, I saw that.
Lukewarm response, certainly. We aren't seeing a firm necessarily, move lower on this. It's down only about a couple of tenths of a % on this news. But it's worth noting here that Klarna obviously betting big on the current environment that we're in. This expectation that consumers really do want flexible spending options here. And not too long ago, we had PwC consumer industry leader on the set, Ali Furman over at PwC. And I spoke with her about what exactly are the expectations, essentially around what will be likely a rate cut tomorrow as well. And she emphasized that consumers really will be seeking out deals, seeking out flexible payment options and ways to stretch their dollar. And so while we're hearing just initial response, initial coverage from the street, many saying that they do think that Klarna is more of a fintech growth stock that is likely to trade with high beta fintech companies. Also worth noting here, though, that it is a bit of a lukewarm response. Not too much optimism just yet, but really early innings here, Josh.
Yeah.
Let's not set too high of expectations.
Right. Needham is a hold, and concerns about the expense outlook and valuation is what they called out. Unable to recommend shares at this time, Brooke.
Yeah.
All right, turning to Ralph Lauren, let's look at that one. That retailer providing its long-term financial outlook that seemed to disappoint investors. So they provide this long-term financial outlook. They did reiterate their 2026 guidance. They think revenue, it looks like, will increase at a compound annual growth rate. They call out of mid-single digits. That's constant currency. They do say at least $2 billion is going to be returned to shareholders through 2028. Most on the street do like this name, by the way. They think it's a buy. Stock is up strongly this year, we should point out. I mean, it's up about 35%.
Yeah, there's 14 buys on the street. So even with this pessimism right now that we're seeing on the stock, as you noted, year to date, the stock is up more than 36%. There's 14 buys, 3 holds, and only 2 sells on the street right now. And I dove into a bit of the call, and what they're really banking on is this inclusive luxury, something that everyone wants to be a part of course, if they can afford it. And really this idea that this is a brand that has such high quality, that they continue to see customer growth. They said that in only 3 years, they added more than 6 million new customers to their direct-to-consumer business, so more access to the brand as opposed to maybe only going to certain stores that carry Ralph Lauren. But this inclusive luxury idea, of course, you have the Polo Bar, the Ralph Lauren coffee, and so this idea that it's more than just a clothing brand, it's a lifestyle, it's something that you could be a part of if you have 1 or 2 pieces of clothes, maybe.
It's an inclusive luxury lifestyle.
The quiet luxury there. But certainly they're looking for, they're being a bit prudent here with that mid-single digit growth expectations over the next 3 years, particularly because of this uncertain environment that we're in.
Let's get one more in here. Hershey Foods getting a lift after Goldman Sachs double upgrades that stock. Go from sell to buy. The rare, unusual double upgrade. We go to a buy here, Brooke, talk about how Hershey has historically had strong pricing power, cost pressures from tariffs and cocoa. They say that's well understood. We know about it. It's in there. More compelling risk profile, target 22.
Yeah, investors sweetening up to Hershey's today.
Nice.
Up more than 4%, as you can see right there. And really, this company, year to date, has been seeing a bit of a return here as investors grow optimistic about what exactly this growth story could be, the purchasing power, or rather the pricing power that this company could have, especially ahead of that key holiday season. The stock up more than 14% year to date. Also keep in mind that on the call, they said that 75% of items are under $4. They also noted that they expect prices over the next year to increase based upon to offset that cocoa. They said that that's inflationary. Of course, there's so many weather patterns that are impacting the cocoa supply right now. They expect double-digit price mix in 2026, but it's still a relatively cheap good. You know that consumers aren't necessarily really going to pull back entirely from maybe splurging on the candy this holiday season. We also do have a new CEO, Kirk Tanner. He started in mid-August. He came previously from Wendy's. He was the CEO there. He also served as the CEO of PepsiCo Beverages North America. And when you keep in mind, over the past, say, year, this stock is down a little bit, down more than 3%, up on the past 5 years, up 35%. And so really, investors here are saying that maybe now's the time to buy into the future story that we're playing into.
Yeah, most on the street say this one is a hold, but not Goldman. Buy Hershey. Thank you, Brooke. Coming up, consortium of firms are enabling TikTok to continue operations in the U.S. under a new deal. We'll tell you who they are and what the plan ahead could look like. Stick with us. Framework for a potential TikTok deal will include Chinese parent company ByteDance and Oracle, as well as new investors. That's according to reports from CNBC. The U.S. also extending now the deadline on Tuesday for China to sell the social media app until December 16th. For more, we're bringing in Yahoo Finance's very own tech editor, Dan Howley. Dan.
Yeah, Josh, this is coming together in multiple stages. We saw President Trump truth, I guess is what you would call it, as post on Truth Social, that they had some kind of agreement for an app that young people would be interested in. Then later, Besson basically saying, yes, we have a framework for some kind of reconciliation with regards to the U.S. and TikTok and China. And so now we're seeing more reports coming out about what that could look like. Part of it would be 80% or so would be owned by U.S. entities. Less than 20%, or roughly under 20%, would be owned by China, so or Chinese prior Chinese owners. So that's what the law has in the original law states that Chinese entities can't own more than 20% of TikTok or it gets shut down. That was supposed to happen in January, and it did for a few hours. And then it's just been kind of, we've been rolling this, along for however long it took to get to this point. Apparently Trump and President Xi Jinping are supposed to meet on Friday to discuss this, kind of finalize it, and I don't know, maybe they'll get on TikTok together and go live or something and say, we saved the app. That would
be good television. Oh, yeah.
Oh, yeah, it would be amazing, yeah. But it does seem as though that's going to be kind of where this goes. It's obviously been a big back and forth. There's been concern about cybersecurity or the security of U.S. users, their data. What does that mean then if we're going to see that become a U.S. property? I think it's still kind of up in the air. Sure, their data isn't going to be an issue. It's going to be held in the U.S. But, part of this concern was, which is, by the way, just been so poorly described, this concern about data. No one's ever really given us a straight answer from the government. It's just been this kind of, they're going to get you. I don't know who they is, the Chinese government. Are they going to know that I look at videos of toys from the 1990s? I mean, big deal, you got me. But part of the problem was going to be potential Chinese influence campaigns and their ability to influence public opinion, maybe use it as soft power, get people to like China more. The thing is, they can do that on other platforms, and they do. They do, it on Instagram. They'll do it on YouTube. It's not something that's difficult to, buy an ad campaign and, zhuzh it up and say, okay, China's pretty rad. And so that's something that I think, still needs to be explained. I don't think we're ever going to get that now at this point about what the old fear of TikTok was. But it does appear as though we're now going to potentially, barring any kind of wild changes, see TikTok continue in the U.S. Going forward.
All right, Dan. Thank you. Great update as always, sir. Taking a look at China, the KWEB ETF, which tracks Chinese tech stocks, is ripping this year. But policy headlines, we know they're moving fast. Beijing has a new probe into NVIDIA. There's a potential TikTok agreement in sight. For more, I want to bring in here Brendan Ahern, CraneShares CIO. Brendan, great to see you. So let's start with this move in the KWEB, because this one, it is up now, Brendan, around 40% this year. Let's start there, Brendan. What explains that move?
Yeah, I think the DeepSeek moment in January of this year really showed that Chinese technology companies have the ability to innovate on their own. And that forces kind of the valuation comparison on U.S. AI tech versus China tech. And certainly the China tech looks absurdly cheap in comparison. I would say if you step back, this rally has actually been happening since January of 2024 when we had a capitulation bottom. So this re-rating of Chinese stocks has been happening for some time. It's just kind of hitting people's radars with some of the recent outperformance between U.S. equity markets.
Brendan, when we talk Chinese tech names, we all know, we know the giants, we know the Alibabas. Are there, Brendan, in your opinion, are there relatively lesser known Chinese tech names that in your opinion should also be on our radar?
Yeah, there's a whole host of names we really like. Obviously, we love companies like Alibaba. Certainly, Tencent is back near its all-time highs, similar to a company like Trip.com. So yeah, some of the names we like are names that, like KWEB, are coming out of a deep base. So they're outperforming. But some of these companies, particularly Bilibili and Kuwashu, they've grown revenue significantly since their all-time highs back in 2021, but are more than 80% off of the stock highs. So we think this is a little bit of an opportunity, similar situation with the broader KWEB today.
So Chinese tech is working, or at least some Chinese tech, Brendan. In terms of other Chinese sectors and verticals, where are you seeing the strength and weakness?
Yeah, certainly within the China internet space, e-commerce companies like JD and Meituan have really lagged, and some of these online video, online entertainment companies have done well. But bigger picture within the China space, it's really the growth stocks of what's been outperforming. Very much humanoid robotics. This is quite. We have some skin in the game. We launched a global robotics ETF called KOID, KOID. So self-serving and highly biased, but those names are really outperforming today. And that's an area where we see a lot of automotive companies making that transition into robotics, just as Tesla's doing so here in the US.
Let me get your thoughts on NVIDIA as well, Brendan, because there you saw China ruling NVIDIA violated anti-monopoly laws. This morning, Brendan, Scott Bessent was on CNBC. He was saying American negotiators expressed their disappointment, he said, to Chinese counterparts when they learned about all this. What do you make of those headlines? Some, Brendan, obviously really thought this is China, throwing some muscle, throwing some leverage around during these trade talks in Madrid. But I'm curious to hear your take.
Yeah, I think it's very likely this is a little bit of the art of the deal from the China side of trying to apply pressure where they can. And certainly NVIDIA is very dependent upon China for revenue. They have a lot of operations in China. A lot of Chinese companies are very dependent upon NVIDIA. So I think they're maybe trying to play their hand. The other thing that I don't think you can discount as zero probability is simply, the Chinese government is a bureaucracy with all these different government agencies. And it's feasible that the agency that put this out, the SAMR, State Administration of Market Regulation, they put this out maybe not even really knowing about the Madrid talks. I mean, I know that most people would say that's inconceivable, but it's something we've seen as students of China's government. It does happen on occasion where government agencies don't necessarily read the tea leaves and accidentally go against what the highest level of Chinese government is trying to accomplish.
A broader question, Brendan, that's asked on the show, and I want to get your take, is should the U.S. government even be allowing, Brendan, companies like an NVIDIA or an AMD to sell AI chips into China? Some have argued no, full stop, that is a national security risk. Your thoughts on that?
I mean, certainly I think we all know that certain strategic industries, if it's semiconductors, steel, need to be manufactured here in the U.S., just we saw the issues around supply chain during COVID. So it makes sense to manufacture some of this here. At the same time, should we be concerned about a chip that goes into your toaster that's made in China? I don't think so personally. I mean, I know this is getting harder because companies like a Sony with its PlayStation, or it's very difficult to understand what is that NVIDIA chip used for. But I do think that the vast majority of these chips are used for really non-military purposes. And from the China side, they're not going to want their defense industry to be dependent upon U.S. semiconductor companies. So I actually think they've moved away from utilizing U.S. semis from a military defense purposes, just as the U.S. is trying to ring fence Taiwan semi with the Arizona factory for the purposes of our military.
Finally, Brendan, I want to get your thoughts on TikTok, that drama, because we had more news today. We had a framework apparently in place. Then we got new details this morning being reported. Brendan, you saw this. Apparently, the algorithm would be licensed to a new U.S. entity. I'm curious to get your thoughts on that headline. And were you sort of surprised by this, Brendan? Because I think some had thought TikTok was going to be just, kind of a part of a bigger, broader deal with China. But now it sounds like, again, reportedly, it could be just being kind of carved out here.
Yeah, I think we've been skeptical about a TikTok going to zero, just being turned off, because if you could just go on ByteDance's website, which is just ByteDance.com, you can see that the majority of the investors in ByteDance, the actual control of the company, is predominantly U.S. and global private equity. So if you simply think about, if you make TikTok a zero, you're really hurting those investors in ByteDance, some very well-known U.S. and global private equity firms who are investing on behalf of your alma maters, endowment, your local foundation, your local pension fund. So I think you're seeing a solution that hopefully allows the original investors in ByteDance to be able to monetize that part of their investment via TikTok, as well as addressing some of the national security issues. And I would agree with Dan's point that the vast majority of what takes place on TikTok, if the Chinese government wants to know what teenage kids are, what their dance moves are, by all means have at it. I think some of this is blown a little out of proportion.
Brendan, always great to see you and to have you on the show. Thank you. Stay with us. More market domination. That's straight ahead. Breaking news, Microsoft announcing a major investment in the United Kingdom just before President Trump is set to land in the UK for a state visit. Microsoft President and Vice Chair Brad Smith saying in a statement the investment will total $30 billion over 4 years, saying it is the largest investment in the country ever. Half of the investment is on building out the UK's cloud and AI infrastructure. Microsoft CEO Satya Nadella also speaking in a new video, saying the company is committed to creating new opportunities on both sides of the Atlantic. This announcement is the latest in a string of similar moves from American companies ahead of the president's trip. Alphabet just announcing, remember, a $6.8 billion investment on Monday. Dan Howley, still with me. Dan, the Howley take on these headlines. What do you make of it?
Look, I think that, one of the things that if you look at, we have the Microsoft 30 billion, 15 billion going to capital expenditures, 23,000 advanced GPUs. No real name there as to which ones they are, but they say they're working with Nscale to build them out. It would be the largest supercomputer in the UK. And I think, one of the things to look at first and foremost is this isn't, the first time a European country's gotten this kind of play when it comes to AI and companies looking to build out AI. France had their own conference where there was a lot of talk of building out their AI over the summer. The other thing is, obviously, this is a race to see who could have released their announcements first, either Google or Microsoft. Google with their £5 billion announcement, which works out to about $6.8 billion. Microsoft coming later, but just kind of dunking on them, saying, oh, we got 30 billion. What's going on there? And I do think it also, though, speaks to how important it is to not just have AI business in the US, but to building it out globally. You got to think these things are just like regular data centers, right? You need to connect. You need to connect at the speed of light. The further away something is, the more time it's going to take to get an answer. People in the UK want to get answers. They don't want to have to wait for something to come from Ohio. So they build them there. So we're going to see more of these build outs across the globe, and I think that this is just the start of it.
All right, thank you, Dan. Appreciate it. Meanwhile, the consumer showing some signs of strength. Our own Brooke DePalma sat down with Best Buy CEO Corey Berry earlier. Take a listen to that.
I do want to kick off with the retail sales number. We did see some softness within electronic sales last month. They were up about 0.3%. Describe to us exactly what you're seeing with the state, the demand of the consumer heading into the holiday, and are they pulling back a bit?
Well, we actually had a chance to release our earnings at the end of August, which is perfect timing. And we had said at that point, we were already running in low single-digit positive comps. We were seeing strength in computing and gaming and headphones and wearables and mobile. So we actually were continuing to see that strength, especially through back to school. And then we forecasted that for the quarter, we'd probably end up similar to our last quarter in terms of comp growth. So it's a consumer who actually, in our mind, has stayed pretty steady in terms of demand.
For months now, we've been discussing the FOMC meeting out tomorrow. Markets are pricing in a quarter-point cut. What are the headwinds up against consumers right now, and how do you expect perhaps a cut to impact the consumer behavior?
I mean, I think what's hard is the consumer is not a monolith, as you know, and we're seeing some different behaviors depending on the consumer. We see almost everyone looking for value. Now, people describe that differently, but very peaky events like back to school or our Black Friday in July event. And at the same time, when there's innovation, something new, like the Switch 2 or like some of the new rev of computing that we're seeing, people are willing to spend on those higher price points for those items that they know they're going to have for multiple years. And so we actually are seeing a consumer, while bifurcated a bit, still willing to spend if they really feel like it's a great value.
And in your last quarter, you did say that third quarter same-store sales are expected to be in line with Q2, but like you just said, we have this Nintendo. We also got those latest announcements from the Apple around the iPhone, the watch, AirPods. Do you think that it just won't be enough to really see a surge in growth here?
I think what we're looking at, back to the consumer point, is a consumer who's being mindful and choiceful. All of those innovations, especially for our model, that is what feeds our model. We consumerize new technology better than anyone. And so we're super excited about those things. And at the same time, very low housing turnover. So a challenge in some of the major appliances or TVs areas. So we're kind of trying to find that balance between super excitement about what's coming and at the same time a consumer who's just being a little bit more choiceful.
Yeah, I do actually want to hit on that because the housing market is something that I've been discussing with executives. I did speak to Lowe's CEO, and what he said was something really interesting. He said that a sub 6% mortgage rate may be a catalyst to get the housing market inflection really started here. You did see declines in appliances and home theater. Yeah. But do you see a turning point to really get consumers back into those big ticket items? Does the housing market need to change here?
I think the housing market definitely helps. It's not the only thing.
Yeah.
Innovation, large screen TVs, those are also things that make people just excited to want to, especially have entertainment at home when maybe they don't want to spend the money to go out. And so there's a real value prop there. However, having more turnover in the housing market definitely helps because you're more likely to outfit that entertainment room or your kitchen or any of those spaces. And I agree with Marvin. I think that if you could just get below kind of this catalyst number, you might start to see that turnover because I think people are really looking for just an affordable new home to buy.
Yeah, and when you think about appliances and home theater, these are pricier goods. Are the everyday consumer going for it? Do you see only high income shoppers really willing to spend that sort of splurge?
I think what's great and unique to our model, all we do is consumer electronics. And all we think about is how can we provide the biggest, widest assortment at all the price points. So we have everything from a very opening price point. You can get a humongous 100-inch TV for sub $1,000. Or you can work your way all the way up to the most premium TV that you could want. And our goal is just whatever your budget is. Doesn't matter where you are on the income strata, wherever your budget is, we have something for you.
We did hear from Moody's this morning that the high income consumer is really driving spending here in the U.S. Do you see that at your stores?
Interestingly, we have actually seen all of our consumer cohorts continue to spend. Now, again, they're thoughtful about what they might go for more of an entry point TV versus a really high end one. But we have actually, when we've even seen some growth in the lower income consumer.
Oh, interesting. And what are they going for? Are they going for those promotional deals?
I think there's a few things. Our model is really built on replacement and replenishment. Your technology does it dies on you at some point. And
Right.
you know, we're 4 or 5 years out from the pandemic. There was a huge pull forward in install base, and whoever you are, you might need something new in order to do your job. Your phone might have broke, you need a new computer, those headphones you really need in order to do your job. And so that's when we want to be there. And it might not be you need the most expensive computer, you just need a good opening price point laptop, and we have a huge assortment of those.
Yeah, AI's been driving the market rally. Has it been driving replacements as well?
I think it is it's part and parcel with replace. So our model works when you've got replacement cycles kicking in and some level of innovation. That is our
Innovation
sweet
being
spot.
AI.
And in this case, AI being just enough. I mean, it can be something as simple as the AI chips take your battery life from 2 hours to 24 hours. That can be a compelling feature for those of us who travel all the time. And so all we're trying to do is make sure we've trained 30,000 associates to help customers understand what really can they do that's different with AI. And a lot of customers just want to future-proof themselves and make sure they have the right capacity for wherever AI takes them.
And these are things we've been hearing throughout all your quarterly results. Another thing that we've been talking about so much over the past 24 hours is President Trump's giving the idea that maybe companies would pull back and only report twice. We did ask Okta CEO just before about this. He said it's great to talk to investors, but there is this industry obsession about quarterly earnings. What's your take on maybe reporting only twice a year?
I mean, I think our focus has always been how can we get investors the most pertinent information at the right times to make the best decisions. Sometimes I think when you're in a really volatile backdrop, you do want to be laying some of that groundwork quarterly. For me, that's less about the forecast and more just about providing color, just like what we're talking about the business. Yeah. That being said, I think we're all trying to find ways to free up capacity and make sure we're spending capacity in the most value-added areas.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.